It is your money. It is your retirement. It is your life. Understand the power of investing for income. Your money, your retirement, your life. Understand the power of investing for income and why that is a necessity for you in retirement, so that you, the retiree, can live the life you want to live, so you can have comfort and confidence and peace of mind that you will not run out of money. Running out of money, not having enough money, is the biggest fear that retirees have, according to recent studies. No longer is the fear of death the greatest fear that seniors and retirees have. It is the fear of running out of money, the fear of having more life than money. You are listening to the Retirement Income Source Radio Show, and I am your host, Drew Pelton. Thanks for being with me today. I repetitively say this, and I can say it, I believe, for the next 10, 20, 30, 40 years, whatever it's going to be. And I know that when I say it, it is butting up against the voice, the narrative, the thinking of brokerage firms, the thinking of advisors, and ultimately the trickle-down effect of it is affecting you, the listener, you, the investor, you, the one planning for retirement, you, the one in retirement. The problem with this voice of Wall Street, the brokerage firms, of stay put, you'll be okay, everything's wonderful, just hang in there, don't worry, is a problem usually for people in retirement. Why? Well, I am very concerned for many of you listening in, because I think many of you are just doing what you've always done, and that's part of the problem. What is that thing that you have always done? Well, it is the accumulation phase. It is the mutual fund way. It is the cookie cutter way. It's the disease of ease way. It is the herd mentality way. It's what you always did, so you would think that's what you should do when you are in retirement. Big but and big however. When you are in retirement, it is not only just a different phase of light talk of, well, I'm no longer working, but you have to look at what you don't have when you are not working. Let's break this down. The very fact is that you do not have earned income. You therefore are not adding money to your retirement accounts, your retirement savings and brokerage accounts. You are not getting a match if one was available for you, and you are not getting a tax deduction. It is very much a different phase of investing. And therefore, when you are in retirement where there is no savings, there is no added money, there is no tax deduction, there is no earned income, and you're in this phase where not only are you not adding money, but normally most people have to take money, want to take money, and want to live a retirement life that's good and great for them. Unfortunately, too many retirees today do not have the adequate income to do the things that they really truly want to do. I see very, very few retirees, whether they are our clients or they are our friends that we know, really do what they want to do. Now, part of that has to do with the fact that they do not and have not saved enough money. And part of that has to do with the deflation of the dollar, with inflation and deflation. How do you get deflation of the dollar? Printing too much money. The world has changed over the last 40 years hugely. Now, I want to say something because somebody may have picked up on this, because I even said my own clients, well, many of our clients are still, in a sense, too new to appreciating the income they have. Now, I do find the older clients do enjoy their life. We have, at the time of this recording, I can think of a client that we have, and they are in Japan, and they are enjoying life, and they take a lot of different trips and 2 thumbs up, and they know that they have the adequate income where they can take income for this expense of this trip from the income from their investments. That's the key. That's the secret. So to get back to this understanding of the accumulation phase versus the distribution phase, accumulation phase, again, I'll just say it because you really want to think about this and understand this from the standpoint that you want to make a shift. You want to make a shift to an income-generating approach as opposed to just trying to get growth from your assets. It's a very different time when you are in retirement. Again, the positives of the accumulation phase are you are adding money, you're doing dollar cost averaging. When markets go down, you buy more shares, you're adding money, you're perhaps getting a match from your employer. You are getting a tax deduction if it's not in the Roth part of your investments. Now, the opposite happens effectively when you are in the retirement phase, the distribution phase. You're not adding money, and I know this is repetitious, but I'm doing this intentionally because you want to own this concept to then be able to own the necessity of what you must do to not run out of money, and that's making the shift to an income approach. However, to make the point here first, the distribution phase, when you are in the distribution phase, when you are in retirement, when you don't have earned income, when you are not adding additional money to your assets, when you are not getting a match, when you're not getting a tax deduction, this is a very different time. And the problem is when people need income, start taking income in a distribution phase of their life, which is understandable because you either need the money or you need to take required minimum distributions out of your qualified accounts, not your Roth, but your pre-tax savings accounts. When you start taking money out of your accounts, if there's any in any given month, just without a long-term thinking, in any given month, if you start taking money out of your assets in a flat or a down market, you might be selling shares. And this is the key fundamental problem that retirees have, that in down markets, if you start selling shares because you need to take money out of your investments, this is where you start to deplete your assets, and you do end up running out of money. And it's not a good thing. And the problem is it's often slow, and a lot of people don't really see it. You have 250,000, 500,000, a million, 2 million, whatever your number is. And it may still look, relatively speaking, okay from when you started your retirement. The problem is that sometimes it's hard to see when there's up and down markets, when there's some growth and you get some adding, when maybe you're not taking money out immediately, because some people do have pensions and or Social Security payments. And when I say plural, I'm talking about a couple. And so everybody's situation is a little different. And a lot of times it's hard for people to see the reality around them. I believe most people have heard, and even if you've heard this story, I'm going to make the point. And there's the analogy of if you put a frog in lukewarm water and you turn up the heat, that eventually, because the nature of the frog is its body temperature adjusts to the heat, it ends up burning to death, versus if there's a shock type of a situation where you put the frog already in boiling water, they have a shock, they jump out, which is sort of what this radio show and podcast is a little bit like. I'm trying to give you the shock effect so that you are really truly getting this and you make a decision and you jump out of the boilingness that you may not really understand and that you may not even realize. Because a lot of what really truly is happening for most people is it's more with respect to the frog analogy. It's this thing where the water is warming up and you're adjusting to whatever is happening. You're adjusting to, well, the markets go down. And we have had so much since 2009, so many ups and downs and volatility that's gone on. And for the most part, what we've seen is in a long-term secular bull market that we've been in effectively since 2009, the year 2009 into 2025, where now here we are with all these hiccups in the beginning of Donald Trump's office, second term in office, that many of you are so used to it. And even though it's been a lot more volatile since these tariff wars are going on, and without getting into all of that, the fact is there's certainly many jittery things happening in the market, to say the least. There's a lot of ups and downs. There's a lot of question about what's going to happen. Many people are pro Donald Trump and believing in what he's saying. It's the golden age, etc. And many are scared and afraid that he's going to blow up the world, or, I'll say others somewhere in between. I think you get the point. The fact is many of you are nervous. Many of you are uncertain about what's going to happen. Let me say this to you. Regardless of what you think of Donald Trump, regardless of what is going on in the markets, where probably many, if not most of you, are concerned about the future of what's going to happen, at least here in the short term, with respect to your monies. And many of you have lost money. I know somebody that started, and I'm just going to say it, okay? I'm sorry, this is a fact. I saw it with my own eyes. We have somebody that got referred to us. They started, and I only met with them one time. They started with Ken Fisher with $750,000 in October. When he brought in this statement about a week ago, it had $570,000. Let me say that again. $750,000 invested to start with Ken Fisher. Now, when I look at the total that he brought into the office, his statement, and showing me where his assets were, he's down to $570,000. I'm going to come back to that in just a second, because the point of it is that there's too many people not in a good situation. If you're taking money out of assets that don't have high income, and his assets were all G type of assets, growth, capital gains type of assets, TR equals I plus G, total return equals income plus growth. Well, when the growth is turning into an L loss, and you're taking money out, and you don't have enough income from yields at a 5 to 7% level, and you have to start invading principal, this is where people have a problem. And by the way, this gentleman was not taking money out because he's actually still working. He's in his early 60s. What's the point? The point is, when you're in the distribution phase of your life, the retirement phase, if you keep doing the same thing you did while you were working and you're adding money, when you're in this different phase where you're not adding money to your investments, that normally turns into a problem. It normally backfires on most retirees, where they keep doing the same thing over and over and over again. What's the definition of insanity? Where you keep doing the same thing over and over and over again when you think that you're going to get different results, right? You keep doing the same thing over and over and over again, expecting different results, and it's going nowhere when circumstances have changed. So you want to understand this different phase of life. You want to know what you need to do, which is make a shift to the income strategy, the income approach. You need to first understand the power of investing for income. Then you need to know where to get 5 to 7% in yields on a regular basis. Yields, dividends, interest, that's the earnings, that's the income from your investments. This is not the growth. That's not the G part. This is the interest from bond and bond-like instruments, or dividends from common and preferred stock, or other even bond-like instruments that often are considered equities like BDCs, etc. You need to know how these things work. There's too many people caught up in either mutual fund investing where there's low yields, 1 to 2%, and that's not going to carry the day in a down market, and you're going to start invading principal. Or you are, as I've covered in the last month or so, I've been covering these ineffective annuities where people start taking high income out, meaning it's an income, it's called an income, but the reality is you are invading principal. The annuity companies or insurance companies are saying, yes, we're going to give you this income, but the income is being manufactured because the interest isn't high enough. It's being manufactured out of the principal. And when the returns are lower than the percentage income that you're taking out, this is where people invade principal. And this is where you can run out of money even in an annuity. You want to understand how these things work. Mostly, in a nutshell, before I take a break here, is where people run into problems is they have too much of their portfolio in mutual funds or stocks paying very low yields, or they have ineffective annuities where they've been sold the sizzle about some big bonus that isn't real money, and they are not earning enough in the annuity. And when they start taking income, they start invading principal, as I just said. This is the problem because they haven't made the proper shift, in this case from what I just said, to high-yielding assets, individual securities, or if you like guarantees through annuities, and many people like fixed index annuities, then you want to get the right fixed index annuity. If you need a checkup, give us a call on 225-831-1394. That is our office line right here in Baton Rouge, Louisiana. Or if you'd like to get a copy of Dave Scranton's book, The Retirement Income Source, give us a call, and I'm happy to get that book right out to you. And if you're coming in for a review and analysis, we'll give you that book when you come in. All right, stay tuned. I'll be right back. You want to understand what I'm saying. I'm going to tell you some stories about people who are getting themselves in trouble, as well as a narrative that gets most investors in trouble because it carries people as they go from the accumulation phase of life to the distribution phase, where they get this programming keeping them stuck in the old strategy, and that old strategy backfires. You want to understand this. Stay tuned. I'll be right back. Welcome back. You are listening to the Retirement Income Source. I'm your host, Drew Pelton. Thanks for being with me today on this radio show and this podcast. Today, I am talking about what message are you listening to? Now, I didn't say that in the first segment, but that is the topic of what I'm covering today, even though I didn't say it in the first segment. What message are you listening to? Making the summary point about what I was talking about in the first segment, which is the necessity to make the shift from an accumulation phase strategy of investing, how you invested when you were saving money while you were working, to a distribution phase strategy of investing, which is the distribution time of your life where you're taking money out of your assets because either you need the money or you have to take the money out of RMDs. And if you don't make the necessary shift from a I should say, an accumulation phase strategy of investing to a distribution phase strategy of investing, where you should be utilizing individual securities that are getting you 5 to 7% in dividends and interest, which are the yields, and in addition, also getting some gains, obviously, over time. Assets will increase if you're investing wisely, and you need professional money management to help you do this. This is not child's play, getting 5 to 7% in yields. And I have to say this to any of you who may be a do-it-yourselfer. I have to tell you, you may be beating overall the returns of other advisors, but the key focus should be, what are your yields? And yes, total return is important, but when you have to take out RMDs out of your accounts, it makes sense to not try to get your income from growth, because if you have losses, this is where you're going to invade principal. If your yields are lower, I'll just say it this way, lower than ours. Ours are in the neighborhood of 5 to 7% with a diversification of individual securities. And for some, they like the right annuities. I mean, that's what, if anybody comes into my office and says, I like annuities and I want annuities, we're going to get them, quote unquote, the right annuities. What do I call the right annuities? Right for them, tailored for them, customized for them. And in addition, it's going to get, on average, the same type of yield, the 5 to 7% historically, and that's what we are making sure is the benchmark. Because if it doesn't do that, like so many annuities that only get this literally 1% to 2 or 3% in returns, and then if there's a fee because there's an income rider, and people are easily only earning 1 to 2%. And if you're listening in and you have that type of an annuity, I would say you need to run to my office to get a checkup, because there's no reason to put up with that. And I know some of you are saying, oh my goodness, Drew, I don't have a choice, I'm locked up. That's not necessarily true, because there are programs to release you, and there are enhancement monies that are available to allow you to get free from these ineffective annuities that are plaguing so many people, where they've been snookered, bamboozled by the sizzle salesman who has sold them the sizzle of this faux bonus money. And a lot of you don't know. I cannot tell you, and I'll go off on a little tangent here on these annuities, how many people come into my office and I start saying, did you know this? Did you know that? Did you know the other thing? And I'll go through easy 3 to 7 things. And it's amazing to me how people will say, no, I didn't know that. I didn't know that. He or she didn't tell me. Because you got snookered, bamboozled by the sizzle salesman selling you something. And what are they selling you? Oh, your money's guaranteed. Okay, well, the money's guaranteed, but if you start taking money out and you're not just leaving it for a legacy, and you're taking money out at the levels of 4.5%, 5.5%, 6.5% as an example out of your annuity, and you're only getting 1 to 2% returns, you don't even have to like math or know math. That's just not going to work over time. You're going to deplete your annuity asset value. Run over here and to my office, and I will help you. I'm chuckling because I would imagine you would drive, but I'm making my point. Don't put up with that. There is a way to fix that issue and that problem. And that's part of making the wrong choices when you think you're in this distribution phase strategy of saving your money and getting more secure, and you're really making a bad decision. You have to understand what's available investment-wise. You have to understand how to invest when you're in retirement so your money can last. So I'm talking today about the narrative and the message that many people are listening to. And my question to you is, what message are you listening to? Well, if you're listening to this radio show, which obviously you are because you can hear me, you are listening. But if you are on a regular basis, or today at least you're listening in, the question is, what are you hearing? Well, when I'm talking about income. Income. And I'm talking about you, the investor, making good and great decisions for you. It is your money, your retirement, your life. Your money, your retirement, your life is the sentiment to embrace. And then you need to make executive decisions. And some of you who get a little lazy, or you get fearful, or you get stuck with people that you just think are good, and you're not embracing this seriously, where it's like your health. If your body is telling you you don't feel, saying I don't feel well, and you're not doing well, and you have a problem, and you don't go to the doctor to get it checked out, you may have more serious consequences, from much worse health to even passing away. I mean, it's smart when your body tells you something that's somewhat easier, because you don't feel well. Now, many people, or too many people, I should say, don't really focus in, and they just think, oh, I'll be okay. But when there's a problem, and there's a problem with health, you should go to the doctor. Well, relative to your investments, you want to have a wealth checkup. Just like with the doctor, you have a health checkup. With your money, you want to have a wealth checkup. And as fast as I say that, I know many people listening in here are thinking, well, Drew, I'm not very wealthy. Well, we're calling whatever asset you have, it's your wealth. It's whatever you were able to do. It is what it is. But many of you, if not most of you, if not all of you, if you're not a client, need a wealth checkup. You need a checkup to see how you're doing. Are you still stuck in the accumulation phase? Do you have too many mutual funds? Do you, in your portfolio, not even keeping up with the S&P 500 index? Do you have low yields, which would be the case with mutual funds? Do you have too much risk in your portfolio? Well, most people do. Most people, I've said this many times. I don't have people come into my office and I say, wow, that's fantastic. Look at how well you're doing. I mean, some people do better than others, and some people are in a stronger position than others. But when people come into my office, I see problems. Now, I know some of you are listening and saying, well, I'm one of those people. I'm good, Drew. And that's part of the problem. And I'm going to get to that next. So let me just say, if you think you need a checkup, get the checkup. We're happy to help you. Call us on 225-831-1394. 225-831-1394. If you don't think you need a checkup, guess what? I think you should go get one anyway, because what does it hurt? How many of you go for a regular checkup, medically speaking or health-wise, even though you feel good and you don't think you have any problems? I do it. And my wife, Karen, is always saying, Drew, go get a checkup. I've said, Karen, I feel well. She says, yeah, go get a checkup. Just make sure. Because we all know that sometimes people can have problems even when they think they are good or they feel good, etc. Well, it's the same type of thing with respect to your monies and your wealth and your retirement funds. Get a checkup. Make sure you're doing what's good and right for you. Call us on 225-831-1394. And if you'd like to get a copy of the book, The Retirement Income Source by Dave Scranton, I'm happy to get a copy of that out to you. Or if you come in for a review of your portfolio, where I'll be able to help you understand the risk you're taking and the income you might be generating, and how you're generating it, by the way, because some of you may be generating and trying to generate that income or manufacture that income out of a growth strategy, and this is where you get into trouble. So let me transition a little bit to tell you what I really mean when I say, what message are you listening to? Well, I'm saying here, you should be listening to the message of income. You should
understand the message of income. You should understand the power of investing for income, where you're getting income from income, where you understand it's all about income, because that's going to drive stability. It's going to drive capital appreciation. It's going to drive the income you need. But here's what I see on the other side. What's the other side? It's the cookie cutter, disease of ease, lazy, general conversation. So this is how, if I wanted to get a job at Merrill Lynch, Morgan Stanley, Ken Fisher, Valig, LPL, any brokerage firm I want to say, here's how I get the job. I'd say this: hey guys, watch this. I can do what you guys do. Now, hopefully some of you here realize I'm about to be facetious to make my point. So here it is. I'm in my job interview. Now, I run my own. Let me pause here. This is Drew Pelton, as in Drew Pelton Investment Services. You're listening to the Retirement Income Source. I'm your host, Drew Pelton. So I'm not applying for a job. I've never had a job with any of these firms. And candidly, I would never want to, because it's too cookie cutter, too disease of ease. So here's my point. Here's how I get the job. I say, okay, Mr. Manager, well, listen to me. Watch what I'm going to do. In up or down markets, particularly in down markets. Here goes. Mr. Investor, Mr. and Mrs. Investor, stay put. You'll be okay. Hang in there. Don't worry. Markets do go down, but they come back up. You'll be okay. Hang in there. Everything's going to be okay. Stay put. Don't do anything. I'm pausing. Yes, that's the narrative. That's the message. And many of you just think, oh, okay, well, my guy told me that. He's always told me that. He keeps telling me that. I have to tell you this. If that's, look, let me go back to this. I'm hired, right? Because, that's what everybody says out there. So guess what I, Drew Pelton, have to say about that? If I'm your coach and I get to say whatever I want to say for you, I go to the broker with you, and this is what I say: you're fired. You're fired. That's all you have to tell me? Stay put, you'll be okay, hang in there, don't do anything, you'll be okay. Markets go up, they go down, but you need to stay put. It's all about buy and hold. You can't get out now, you can't do anything. Oh my goodness, oh my goodness, oh my goodness. That's all you have to say? This lazy, stay put voice? I mean, what message are you listening to? If you are listening to that message, I would say this again, because earlier I was talking about if you have these ineffective, not good annuities run in here. Well, let me tell you, if you're listening to the voice of any of your brokers out there saying that, I would say you should run to my office, because that is ridiculous, in my opinion, to say the least, my opinion. I can just tell you, I have found it in 40 plus years of doing this, that is an ineffective way to go. Let me tell you a little story. I was just talking about a gentleman who came into my office. He was referred to us. He starts with Ken Fisher, and I'm naming it because it could be Ken Fisher, Merrill Lynch, Morgan Stanley, but this guy just happened to be with Ken Fisher. And Ken Fisher, I'm sorry, this is your portfolio. So I really don't need to apologize for what I'm saying, because this is the truth, the whole truth, nothing but the truth. So the guy comes in, he says he starts with Ken Fisher last year in October 2024. And he comes into the office early April, it was about a week or so ago. And he says, not only says, he shows me that the $750,000 is down to $570,000. Why? Too much at risk. Too little dividend yields, which is in a sense the least of it in this case. Why in the world would you be allowing that kind of decline in your portfolio? He didn't know, because, I'll tell you how it goes. It goes what I'm going to repeat. Stay put, you'll be okay, don't worry, hang in there, everything's wonderful. It's all about the long term, and that's what they told him. Because here's what the gentleman said, and hear me on this before I take the break. He says, maybe we should go to cash and then think about buying low, or when the markets start to come back, then we can repurchase. In other words, what he was saying to him is like a a month and a half, 2 months ago, he was saying, maybe I should go to some cash here and then we'll buy back in. Let me tell you what I told him. I said, I think that's a good thought and a good idea. And first of all, we don't typically have people at such high risk where we have to make those kinds of moves. But let's say somebody came to me and early in January or even in early February, and they start seeing jitteriness in the markets, I would have said, that makes sense to me. Here's what the representative tells them. Well, we just think about the long term, so stay put. Now, let me say something to you folks. What's that representative's selfish motive? If they go to cash, they probably shouldn't be charging you a management fee on that cash. And first of all, don't just go to cash. You could sit in a money market and make 4% plus. Last year in our money markets, we were making 5%. But there's strategies other than what I just said. What is it? Stay put, you'll be okay. Hang in there, everything's wonderful. It's all about the long term. You can't get out now. I want you to think as an investor. What is the motivation? What is the motive of the investor first? But I want you to understand that. What's your purpose? What's your motive? But here's the other thing. What's the motive and the motivation of the advisor or advisory group or brokerage firm you're working with? Is it to keep you in the market so they can at least get some fee on that? Is it they don't want you to move to somebody else? So when I come back, I'm going to start to address when people say, I can't do anything now. This is a big problem hang up that people have. I can't do anything now. Okay, stay tuned, because if you're saying that, you need to hear this next segment, because it's typically a major problem. And I could argue it's an insult to me. I don't get insulted, so I don't care. But it's really what it means is you're not thinking through this wisely. You don't want to miss this next segment when I talk about this. All right, stay put, please. I just said stay put. That's what you're listening to in about the markets. Excuse me. Let me correct that. Please stay tuned, because you don't want to miss what I'm about to share about a narrative that can get you in trouble. What are you listening to, and how is it impacting you? That's what I'm talking about today. Stay tuned. I'll be right back. Thank you. Welcome back. You're listening to the Retirement Income Source. I'm your host, Drew Pelton. Thanks for being with me today. Today I'm talking about, what message are you listening to? I'm talking about understanding the message that you have been told, that you're listening to. And I'm also talking about the message that I am certain, not just confident, certain, you need to hear and understand, which is what? It's the power of investing for income. It's income investing. It's income generation that gets you a balance in retirement investing. What is that balance? And that balance, which is about successful retirement investing, it's the balance of getting income, it's the balance of getting growth, and it's the balance of getting stability and security in your investments. So what is the message that you're listening to? Is it the message of growth? Stay put, you'll be okay, hang in there, everything's going to be wonderful? Or are you listening to the truly the message that works, which is the message of how not to run out of money in retirement? It's the message of how to get sufficient income from income. Income you need to live on from the income from your investments, as opposed to the principal or where you think you're getting monies from capital appreciation, where too often you're getting it from losses, and those losses mean that you're invading principal when you have low yields. You need to understand this message of income. Don't take it for granted. Income. Why do I keep talking about income? Why is Dave's book, The Retirement Income Source, which you can get a copy of if you call us on 225-831-1394, and you can also get a complimentary review and analysis of your portfolio when you set up a meeting But why is Dave's book, The Retirement Income Source, also our franchise name, which is the Retirement Income Source? I'm one of 18 shareholders out of our 150 office group. And as we grow around the country and the message of income gets bigger and bigger, because it is the power that people need when they are investing in retirement so they don't run out of money. So I mentioned before the break, I want to talk about something that we keep hearing. I've heard that this is over the years. It's not just now, okay? But in this market with a lot of volatility and the tariff wars or the tariff unknowns or the tariff issues and things that Donald Trump is doing that is causing, as he said, some disruption. And there's a lot of skittishness. There's a lot of fear and worry and concern by many people. Now, I know some people aren't, and they just are bullish and they think everything's going to be okay. But there's so many people in their losses, like I've been talking about this gentleman who was trying to advise the Ken Fisher representative. Notice what I said, that he's trying to advise the Ken Fisher representative or suggest, hey, maybe I should go to cash, and the Ken Fisher representative tells them to stay put, you'll be okay, hang in there, don't do anything, we're all about the long term. Well, that's all you have to say? That's all you have to say? That's how you help somebody? That's how it seems to me, in my mind, 99 out of 100 advisors, that's what they say. That's their mantra, that's how they go, that's how they fly. So all of that then translates to this. So I'm giving the advisor talk. Who hasn't heard that talk? When I say that in the seminar, stay put, you'll be okay, hang in there, everything's wonderful, don't worry, even though the market's down, they're going to come back, you didn't lose anything. I mean, I even heard Dave Ramsey the other day on Fox News. He says, well, I haven't lost anything. That was his opinion. Well, his accounts were down. He says, because I haven't taken anything out. Well, here's the whole thing, Dave Ramsey, and I like Dave Ramsey, and I think he's a good guy, and I think he's very intelligent, and I think he gives sound advice with respect to people not being in debt, but that's typically a younger person version of counseling. But apparently he's helping and counseling the masses and not helping just retirees, because what kind of message is that? Like when he's trying to argue, well, hey, I didn't lose anything because I didn't take any money out, which is the problem here, that many of you, like you're running around with that thought if you're in that situation. The problem is when you have to take money out and this is a message, he's putting that message out, but he's not connecting dots to seniors and retirees that have to take out RMDs, because if you're having to take money out, and he was talking about, well, I didn't lose anything because I didn't take it out. Dave Ramsey or whoever else, and again, I'm not picking on Dave Ramsey per se, but I would have said your message was short, because the appointment or the interview was over right after he said that. And he smiled. He has a nice smile. And I was thinking, if I'm on that show, I'd say, wait a minute, Dave, and newscasters, what are you talking about? What about the retirees that are taking money out on a regular basis? What kind of message is that? That I didn't lose anything. No, you're going to lose things, and you're going to be selling shares. You're going to be in a problem. So all of this said, so here's the thing we hear all the time, and I think about Lance in my office, or Patrick, or William, various people, Misty, virtually the whole office, myself, others in my office. They hear the same narrative from people, which is the narrative of, oh, I can't do anything now. What? What do you mean you can't do anything now? What does that mean, you can't do anything now? Who taught you that? Why are you saying that? Do you really know what you're saying? What do you mean you can't do anything now? We're talking to them, and look, don't come in here, but I'm trying to help you. When I say don't come in here, no, you do need to come in here. But I mean, if you're going to be hard-headed and stubborn, so to speak, and many of you are hard-headed and stubborn, not because you mean to be, but you're so programmed by these brokers and Wall Street, stay put, you'll be okay, hang in there, everything's all right, don't worry. And and that's your mantra. I mean, I say it so quickly because that's what I hear. That's what everybody says. We don't say that in here. Stay put, you'll be okay, hang in there. Well, first of all, what we do is set strategies that are income-based strategies that work generally through up and down markets. So that's the first thing. But when these people that are in a growth mode, it's the growth mode only, the low income type of portfolios that are shouting this out, stay put, you'll be okay, don't do anything. Well, what kind of advice is that to a retiree that has to take money out of their portfolio? It's not good advice, because you're going to start selling shares when you don't have high yields, because typically that's what comes with it. So this guy, the Ken Fisher guy example, he was giving me a little bit of that when he came into my office. He didn't give me much of it because I'm giving him the message of income, and he actually got quite quiet by way of, I would say, an expression of, I think I'm hearing something I've never heard before. And that's a lot of what's going on here. Many of you are hearing something you've never heard before, and that's good and bad. What's bad about it is you should have been hearing about it. This message should be pervasive in America. This message should be pervasive by way of the substance and the methodology and the strategy of investment firms generally, but they don't do it. Why not? Because everything is so cookie cutter. Everything is so massive with trillions of dollars in the stock market that the only way to get it to the masses is through mutual funds. So the only way you, the retiree investor, can get this is you have to come to a specialty firm that specializes in income generation. You are listening to a man that's part of a group that does that. We are all about income. Income, income, income. It's all about income. What does that mean? We specialize in generating high yields, high income, so you can get income from income, so you don't have to invade principal. The opposite of what most of you are hearing, that turns into, you ride this roller coaster. I can't do anything. Let me stop. Let me pause. You can do something. You do have choices. When I hear people say this, like, I can't do anything now, what do you think that means? What do you think, like, you just started working with us that we don't know what to do? Or, it's really, you really don't know what we do. Because the fact is, you can do things. You can stabilize your assets. You can get appreciation. And you can do something that's called an ACAT transfer, ACAT, capital A, capital C, capital A, capital T. You can do an ACAT transfer, which is an automated customer account transfer, which is how you transfer assets to a brokerage firm, Charles Schwab, Fidelity, like we utilize in our fiduciary registered investment advisory approach, investing for income. And then you can start to reposition intelligently and work with a professional management group that does customized tailoring to people's needs and wants, as opposed to stay put, don't do anything. It's just a generic, broad brush, get you in trouble kind of an approach. I hope you're hearing me today. I really do, because I'm very concerned for many people who are hanging on for dear life, and all you're doing is hoping and praying. You've been told to buy and hold, but what you're doing is you're hoping and praying that the guy that told you to buy and hold, take risk, and you must take risk to make money, you're hoping and praying that's going to work. And I have to say, I don't believe hoping and praying is a way to invest monies. I like hope. I want to have hope in life. I want to pray. I want you to have hope, and I want you to pray, but I want to do it based upon facts, truth, substance, understanding of income, and understanding it is your money, your retirement, your life, and you need to understand the power of investing for income, and you want to invest for income. Case closed. It is closed by way of, this is right. Okay? It's not just right because I say it's right. It's right because it works. It's right when it's right for you. But too many of you are just caught up in the herd mentality, the herd approach, not herd like HEARD, but HERD, like cattle, like you're part of the cattle call. It's herd mentality. Well, everybody else is doing it. My guy says it's okay. Take control. Be large and in charge. And how do you do that? Give us a call on 225-831-1394. That's our office line. Or if you are calling us on the weekend or after hours, you can tell the associate to have us give you a call back. You can call us anytime on 1-833-974-1833. That's our 24/7 line. And you can get a copy of the book by requesting that on either number. The 24/7 line is 1-833-974-1833. Or if you want to call us during business hours, which is what I would encourage you to do, call us on 225-831-1394. 225-831-1394 right here in Baton Rouge, Louisiana, where most of you listening in are. Anyway, and it makes it easy. So I think you need to get this book, The Retirement Income Source by Dave Scranton. It'll help you understand the power of investing for income and how you can get renewable, residual, dependable, reliable income in your retirement, and how you can live from income, out of income, by income, with income, so your income for your lifestyle is good and great for you, and you can preserve your principal for the future to keep up with inflation and have money because of inflation. And often 70% of us, generally speaking, are going to be subject to some kind of long-term care. All right, I'm going to take a quick break before we wrap this up. Thanks for being with me today. You're listening to The Retirement Income Source. I'm your host, Drew Pelton. I'm with you every weekend on the radio, and if you're watching by podcast, watching and listening, obviously, then you can catch me as you need to on the internet on YouTube. All right, stay tuned. I'll be right back. You don't want to miss understanding what you need to do. Don't make this mistake of getting caught up thinking you can't do anything and there's nothing to do. There is something to do, and you need to understand it. I'm sharing that with you today. All right, stay tuned. I'll be right back. What message are you listening to? What message of investing are you listening to? Who have you listened to? Who should you listen to? That is hugely what I'm talking about today. That's the title of the show, which is what message are you listening to? You want to listen to and be part of a message that works for you. That message is the message of income. Why does it work for you? Why would it work generally for everybody? It does because people need income in retirement, whether they need it for their lifestyle or they need it because they have to take required minimum distributions out of their retirement accounts. You must understand, for your sake, how to not run out of money. And how to not run out of money, or how not to deplete your assets, is about investing for income. You want to mitigate risk and volatility. You want to let the math be your guide when you are making decisions about your money. Not so much, well, I know Johnny, Mary, and they're good people. Look, I like good people. Everybody likes good people. When LSU is hiring a coach in any sport, certainly they want good personalities, but at the end of the day, the coaches need to make teams win. The LSU is not going to put up with, or in any sport, or whether it's professional or college, and certainly LSU has a great reputation of, they don't put up with losing coaches. And if you're not a winning coach in any sport, men's or women's sports, they're not going to be around. You've got to win. And we all love our LSU teams, and we all want our LSU teams to be winning, and we all get behind all that, and we all seem to understand that. But how about you and your money? What message are you listening to, and what are you getting caught up in? You want to understand the power of investing for income so that you are doing what's good and right for you. Your family needs you to do it right. You want to get this right for you, because when you do have the income you need, you can live the life you want to live. Don't be snookered, bamboozled, taken advantage of, led down the path of decreasing assets. Don't be led down the path of generalizing and the disease of ease, cookie cutter message of mutual funds, mutual funds, mutual funds. Hang in there, you'll be okay. You have to take risk to make money. This is where people get into trouble in their retirement years. You've got to understand that it's a different time of life when you're in retirement, which requires a different strategy of investing. Don't take this for granted. You want to be strong in your thinking with respect to making good decisions based upon the numbers. And you want to make sure that you are having a focus of stability and preservation and growth, moderately at least, and also income. That's, you get that triple advantage through income investing. Income investing, getting high yields, will drive preservation and moderate growth and give you the income you need through individual securities and other guaranteed instruments. But you need a fiduciary financial advisor that does true planning. That's the message. What message are you listening to? I hope and pray it is the message of income. Join me every week, and I'll give you a message to help you do good and great for you. Thanks for being with me. I'll be back with you next week. Stay tuned then, and I'll look forward to being with you. Thank you. Be blessed.